So we've picked the assets, we've thought about the discounts, maybe we even got the appraisals done and have all that. What's the next step?
The next step, Maury, is that now we're in 2011 and we have our $5 million gift exemption. So we said a 49% interest in this real estate LLC would be worth on a discounted basis $45 million. So let's make a gift of $5 million of the interest in the LLC. That functions in a couple of different ways. It allows us to leverage the exemption. And what do we mean by that? Well, first we're going to start out by gifting the $5 million. But by gifting $5 million of value, that actually functions as what we call seed money, which means basically there's an economic value inside of this trust which will allow us now to purchase other assets for notes. So what we can do here is, let's say the $5 million represents...
It's kind of like the down payment.
Yeah, exactly. It's just like that. But by having $5 million of value, it allows us to then purchase additional assets. And as long as the seed money is somewhere between 10–15% of what the ultimate value of the assets in the trust ends up being, the government has respected these kinds of transactions. It sort of gives you an economic legitimacy to doing this thing, because the trust has assets to back up the purchase price of additional assets. That's what you and I were talking about, how you can leverage this exemption amount.
And because the exemption has grown, if it had been still at $1 million level, we might be limited on this transaction to maybe $9 or $10 million worth of transfers. Because of this increase in the exemption and the additional seed money we can get in without a tax, it's really given us the ability to move tremendous amounts.
Absolutely. So you'll see now that we get into this, we can then purchase another $40 million of the real estate, which coincidentally gets us up to the $45 million number, which represents the 49% interest in the LLC. So now we're sitting there with $5 million of gifted value, and then we're going to purchase $40 million. And remember, we said interest rates are at historically low levels. So the government will allow you to use interest rates that they benchmark and and adjust on a monthly basis. And as long as you use this interest rate, called the AFR, as long as you use this interest rate, the government will respect the sale transaction and not consider any implicit gifts on the on the sale. So what we can do here is we can say, let's do this purchase of $40 million and let's set up a note for 9 years. Interest only, with a balloon payment at the end of a 9-year period. Interest rates in June of 2011, using what they call a midterm loan, the rates are lower than 2.5%. So we can lock in today on a very favorable borrowing mechanism, pay a lot of low interest, very favorable terms, and hopefully over time we'll be able, through the cash flow, to be able to pay back the interest and then the principal at the end of the 9-year period.
So the value that's going to be left in the grantor's estate, if something should happen to the grantor, will essentially be the principal value of this note plus this low interest that's been paid back to the estate.
Yeah, that's correct.
So we've essentially frozen the amount in the estate at this relatively low discounted fair market value, discounted minority interest piece that's still there.
That's absolutely correct.